Good evening, ladies and gentlemen, and welcome to the webinar this evening with IDEX, KPMG, and Pioneer Legal. We would like to start off by saying that we hope everyone at home is doing well and that you are keeping safe during these unprecedented times. Thank you for taking the time to spend with us this evening. The subject of discussion today is navigating the M&A PE landscape post-COVID-19. Within the next hour, we will try and touch upon various subjects. These include impact on deal structures, valuations, changes in regulations, and specific advice on what can be done to tide over issues being faced in deal making. While we listen to our panelists, if you do have any questions, please feel to drop them into the Q&A box, which you should see at the bottom of your screens. We will try and cover off as much as we can during the next hour, but if for any reason we are unable to do so, we will do our best to address those queries offline. Let me start by introducing you to our panelists. Our first panelist this evening is Mr. Vijay Gupta. Vivek needs no introduction. He is a partner and national head for KPMG India's M&A and PE tax practice. He has over 24 years of experience across corporate mergers and acquisitions and private equity transactions. Some of the recent transactions that Vivek has worked on include the Walmart and Flipkart acquisition. I'm sure you've heard of that. And Schneider's acquisition of L&T's electricals business. Prior to joining KPMG, Vivek led the M&A tax practice for BMR Advisors. He has been regularly ranked as one of India's leading M&A advisors. Welcome, Vivek, to the panel discussion this evening. It's a pleasure to have you here.
Thank you, Pratha.
And if I might add, it's great not to be conversing with you on the other side of the table.
Thank you.
Our second panelist this evening is Mr. Satish Kishan Chandani. Satish is the managing partner of Pioneer Legal, a law firm based out of Mumbai. Satish has been practicing for the last 32 years. He has extensive experience in advising various multinational as well as domestic companies and large private equity funds in the areas of corporate laws, commercial laws, antitrust, and other related laws. He is ranked as one of the top 10 deal makers in Asia by Merger Market and has been awarded Corporate Lawyer of the Year at the Legal Era Awards 2018. Some of his recent transactions involve KKR's acquisition of Eurokits, True North's investment in Biocon Biologics, and the merger of Sumitomo Chemicals with Excel Corp, a listed entity which was one of the first successful reverse mergers in India in the last 18 years. Welcome, Satish. It's a pleasure to have you too.
Thank you, Vijay.
My name is Pritha Jha. I'm a partner with Pioneer Legal myself in the private equity and M&A space. And given the company I am keeping on the panel today, I will skip over my achievements, which will obviously pale in comparison to those of the two individuals joining me. Gentlemen, it's an honor to be with you today. Now then, let's get started. Vivek, a lot has been said about deal making during and after the pandemic. However, no one really quite expected that the lockdown would continue on for so long. It's almost been 2.5 months. What has the impact been on valuations for deals that were already underway? And how do you see this playing out in the months to come?
Okay. So Pritha, actually more than the valuation impact, and I think I will come to that in a second. What I think we are seeing on deal activity, at least across the board, is that there is a considerable fall off in deal activity entirely from both buyers and sellers in this uncertain environment. I think the fundamental truth is that at this point, it is extremely hard to judge as to when this pandemic will exit the world and with what level of damage. Of course, deal naysayers talk about the world having permanently changed, a significant demand compression ahead of us. And therefore, I would say in general, leaving aside certain specific sectors, in general, I think it becomes very, very difficult for any investor, any buyer, any private equity to model the exact impact of the pandemic. It also becomes very difficult for sellers to figure out what's a fair price to sell. And I think that's why our fundamental observation is that most deals seem to have gone into pause mode. So that would be my first point. Now, turning specifically to the valuation question that you raised, I think the core thought process is that even if the basic investment hypothesis was to hold entirely, so let us for a moment assume that we say this is only a very temporary blip, that just like China, who managed to control this in, let's say, in 3 to 4 months, 5 months, India and the world in general will control it in the same way. And therefore, the basic investment hypothesis was to still hold. I think the uncertainty in the current environment directly impacts the risks inherent in an investment. What we are seeing is two things, two reasons why there's an impact on valuation. First, it's very difficult to model how businesses will behave. So take the case, let's say I'm planning to buy a consumer business. It's very hard for me to say where will that consumer business land up in terms of revenue, EBITDA, profitability numbers, etc., for the year 2021 or going forward. Will it be subject to a permanent demand compression, etc.? So there is a basic uncertainty in modeling that business. The second thing is, ultimately, investors are investing in an asset or purchasing or acquiring an asset on a certain return expectation. Returns are always linked to risks. Because the risks inherent in the current environment are higher, return expectations are higher. So let's say my hurdle rate for an acquisition was 15% pre-COVID. Now I'd certainly want and demand that I make 20% on my investment because the risks have gone up. Therefore, my return expectations should also go up. That, again, has a direct impact on valuations. So what we are beginning to see is, A, that deal activity is falling off. B, valuations need to reflect the new risk-weighted reality. And therefore, C, and we can come to it in later parts of this discussion, I think fundamentally the structures for deal making will have to see a change, which accommodates this new reality.
So essentially what you're saying, Vivek, is that it's not really going to be bad for one group of people. It's affecting sellers and buyers equally, because sellers are unable to determine what their business is going to look like, whether it's going to normalize over the next couple of months, whether it will reach the same level of activity that it was at before the pandemic happened. And buyers are obviously unable to punt on the business because they're not sure of the same thing. So would you say that it's equaling them, it's affecting them equally?
No. So what I was saying was deal activity is falling off because both are uncertain. But I think in terms of impact, clearly this will become a more a buyer's market. So today, if I have cash, if I have the ability to purchase, if I have the resources to purchase, clearly it's my market. Sellers don't have those many options. The world is grappling with basic liquidity to keep alive existing businesses, and therefore sellers don't have so many choices.
Right.
All I meant when I said that both buyers and sellers are impacted was that because of uncertainty, it's hard to put a price. And therefore, sellers, where they have the liberty, and oftentimes sellers will be forced to sell, but where sellers have the liberty to be able to ride out the storm, what we are seeing is they're trying to ride out the storm and not rushing to sell their business. Of course, where sellers are approaching imminent distress, etc., it will completely be a buyer's market.
Right. And do you think that the pandemic is affecting deal activity in certain sectors more positively or negatively? We all know the obvious one. There's entertainment, there's hospitality, there's restaurateurs. So, those are the most affected. But there are also others that are seeing an incline just because of the way that the world is functioning at the moment. So how do you look at this from the point of view of sectors?
So look, sectorally, you picked it up absolutely correctly. I think sectors which have faced complete demand drop-off, travel, tourism, hospitality, etc., and linked ancillary sectors, there will be no more deal activity. Some of them who are private equity or venture capital funded will perhaps do down rounds to keep themselves afloat. But most of them, we've seen the newspaper headlines, most of them have looked at huge cuts in costs and so on and so forth. From a deal activity standpoint, I think in general, deal activity will fall across sectors. Some of the sectors, though, where I'm still seeing reasonable interest is the pharma processes that were ongoing for pharma companies. And I think there were some 4 or 5 fairly large processes There were some small $100 to $200 million processes, also some smaller processes running. I think all of them seem to be on track. Some of the financial services, non-lending activities, non-credit exposure businesses in financial services, wealth management, mutual funds, insurance companies, I think those processes are still also ongoing. So that
Right.
sector seems reasonably well protected. Digital, we've seen a spate of deals in one company in the digital space over the last 6-8 weeks. Digital clearly is the way to go. And therefore digital space will also see more deal making activity. But in general, during this uncertain period, I think there will be a fall off in deal activity, and it is time for buyers to actually ready their buying lists. I would say in 45 to 180 days from now, there will be very mouth-watering targets available at good valuations. So it would be time to go out and shop.
Right. And Satish, if I may just bring you in on this, from the deals that were being made right before the pandemic started and now into the pandemic, are you seeing a lot of buyers and sellers now trying to redo or renegotiate the structure that they had initially thought of adopting for doing their transaction?
Yeah, Peter, I would put it in three baskets. One is deals which were supposed to start just before COVID. Those are on pause, or I would say in some cases full stop. I mean, it's off the table. Then there are deals which were negotiated, signed, but not closed.
Right.
Those deals are being re-looked at because nobody contemplated a scenario like COVID or the impact of COVID on the company worldwide. So the present MAC clauses didn't even envisage an impact like this. So definitely all the transactions we've been working on, every deal is being re-looked at.
Right. It's interesting that you bring up that point, Satish. And I know that the discussions around MAC and force majeure have been really done to death in webinars. But there was this whole period where I think MAC clauses were really looked at not from the perspective of how the market is behaving and whether an investor or a purchaser would like to invest in that type of a market, but only restricted to how the company is doing overall and how the business is doing. Do you think that the MAC clause will now become one of those clauses that will be very hard negotiated for the future? Or do you think that people will just continue on with life because, I mean, hey, the pandemic happens only once in 100 years and it's the only time we've seen it in our lifetimes?
No, MAC clauses, I would put it earlier, 5 years back, if you had asked me on a deal, MAC clauses were more just to tick the box. We used to negotiate, not much negotiation because the certainty of deal was very high.
Right.
So clients did not, and also depended on what was the time gap between signing and closing. If the time gap was short, nobody even bothered about the MAC clause.
Right.
However, given the present situation, and I don't think it's now only limited to COVID, the MAC clause will be heavily negotiated. It will not only cover events or occurrences which impact the industry, they would be more generic in nature. So in short, you will not be able to do deals which are irreversible or
Right.
which have higher certainty of happening. So the
Right.
problem will be now deals till they are closed are not closed. So
Right.
so the buyer will insist on a lot of exits in case of situations like COVID or similar or other situations which may arise in future, because
Right.
now everybody will start thinking of the worst.
Correct.
Far beyond COVID. So I think deals will happen, deals will have MAC clauses, but that means now the certainty of deal will be not there till the time the actual closing occurs.
Understand. An associated subject with MAC related clauses are the force majeure clauses. And these have been discussed for months on end now, but they've been really discussed in the context of commercial contracts, not really in the context of transaction related documents, because a force majeure clause does not always feature, rarely if ever, in an SPA or an SHA. Do you think this will now become a norm? Because let's face it, the MAC event really happens before the closing takes place. What happens if something like this happens post your closing, and say you were a travel agency and your business is just shut? Do you think you will see new force majeure structures being implemented in transactions?
Yeah, definitely. In fact, MAC prior to closing is nothing but like a force majeure.
Right.
The buyer and outs, right? So if he believes that the business is impacted, it could decide not to proceed. So in some other words, it's force majeure. Now, if it was an earn-out deal, earlier nobody used to have MAC as a condition for the second payout or the third payout.
Right.
Now that will become a norm.
But I mean, doesn't that really, Satish, destroy the structure of a transaction? Because what you're saying is that there's a strategic acquisition. You may have bought out 75%, hypothetically, and you've left 25% with the promoter. And because there is a force majeure in the midst of the earnout, you decide to pull the plug on the deal. So how will that ever work?
No, see what would happen, there'll be a couple of scenarios which will emerge if it happens during the period of the earnout or a deferred payment. So if let's say the deferred payment was due next year on the 1st of April 2021, this whole year is lost in that sense, assuming. So I think both the parties will have to negotiate and agree on something. So it's not about, because from a buyer's perspective, he's already bought 75%.
Mm-hmm.
And it would want to buy the balance 25. But of course, at the right price, not the price they may have agreed.
Mm-hmm.
Similarly, seller wants to get the money, which is it believes is due, but couldn't get the chance to perform because the whole year is lost. So I think there will be sensible commercial discussions between a buyer and a seller. I do not see, if you go to court or arbitration and try to enforce specific performance or seek damages, how easy it's going to be.
Right. And Vivek, let me just bring you here on the subject of earnouts, and this is sort of the dilemma that even I am facing on some of my own deals, where the transaction is already closed, right? And typically, like all earnout deals are, you have earnout deals which are based on a PAT multiple or an EBITDA multiple. And bang in the center of your earnout, you have the year of the pandemic, and
Yes.
your profits, your earnings, and your revenue has just completely tanked. So legally speaking, if you look at an overview of the document, there isn't really much that you can do, because look, it's dependent on how the business is doing. So the chances of a purchaser saying, tough luck, it's going to be bad, but we can do nothing about it, is high. How much of an argument can you use with respect to, say, normalized PAT or normalized EBITDA? Because look, your business earnings have tanked, but at the same time, while in normal circumstances you would think you could also reduce your outflow, people are still having to pay their employees because of government diktats, etc., etc. So does that play a role within the earnout? Do you think sellers will be able to negotiate on the basis of the definition of normalized PAT or normalized EBITDA?
So look, legally what the seller will be able to do, I think, will be determined in large fact by what are the express terms of the contract. So in some contracts, there will be the whole concept of normalization to occur. But in most contracts, I think sellers will find themselves in a position where an absolute value would have been ascribed, say an EBITDA multiple or a PAT multiple or something like that. And there may be some exclusions, but those exclusions will largely be to do with costs that are imposed by the buyer, headquarter costs, and so on and so forth. So that would be the normal construct of an earn-out agreement. What I'm actually very interestingly seeing, and there have been a couple of cases in the last few weeks where this whole question has arisen, is for people who are in the beginning of their earn-out period, and therefore for the buyer it is important that the sellers are kept in good stead, let us say. So let us for a moment say a deal got signed in December of 2019 and it has a 3-year earn-out period. Let's say on each anniversary of the deal signing. So December 2020, December 2021, and December 2022. These are the 3 earn-out periods. Now, obviously, the buyer wants the sellers to continue to contribute to the building up of the business in the way that he originally envisaged. So I'm seeing people talk about delay in 6-month period, or talk about we will average the profits over 2 years instead of giving you a very reduced earnout for the first tranche, etc. So I'm seeing commercial conversations emerge, even if the legal contract doesn't fully support them, especially where the buyer has continuing interest from the seller. And I would imagine that a lot of commercial conversations in that light will emerge. I don't know, and Satish is a better person to answer, if one can go into a court of law and argue equity on something like this. I doubt whether courts will look at it like that. So therefore, I think legally, while one may still be on relatively slippery ground, but I have seen commercially contracts being re-engaged and people willing to talk about contracting terms, especially for protracted earn-out periods.
Yeah, Vivek, just to add to that is nobody would want to go to court or arbitration in today's environment. So what is happening, you're right, is people are negotiating, extending the period, because the buyer would have maybe bought 51% in December, is still to buy the 49. If he doesn't support the seller now, or the promoters who are continuing to manage the company, his 51% also could become 0. So it is in the interest also of the buyer to keep the company going and supporting the seller, especially in an earn-out situation, and especially if it is the first year or the second year.
Right, Satish. So, I mean, the majority of the earn-outs are just done on the basis the seller and the promoter of the company that has just been acquired will actually help the business grow. It's an inorganic acquisition. So clearly the purchaser has interest in not just acquiring the business, but also the talent that comes with the company, because the promoter may go on to have a bigger role with the purchaser. At the same time, the seller has entered into the transaction on the basis that he's going to make his money on the period of the earnout. So if a purchaser were to say that we're not going to pay you what we had earlier envisaged, that the chances of a seller saying, okay, maybe then, I'm no longer interested in this business is really very high. So what would be your recommendation to both buyers and sellers who find themselves in the midst of this? Because there will be a lot of them out there having these conversations.
So what would be my suggestion to them is that both are impacted. Maybe differently, but definitely there's a common impact, is that the businesses got impacted. And both have a stake in it. Still,
right.
Buyer may have a higher stake, seller may have maybe a little lesser stake, but both have. So both are impacted. The question would be, from a buyer perspective, he would say, I have paid the upfront money. I had to acquire the balance in 3 years. 1 year is lost. Okay. So if I have to do over the next 2 years, I should be paying you less. Whereas the seller says, I didn't get an opportunity to perform, so you give me a longer period. If I give him a longer period, it takes me also longer to acquire the entire 100% and get the benefit. So there will be a commercial understanding, because the buyer is losing some money because it is acquiring the company over 4 years instead of 3 years, maybe, if it's extended. Correct? Seller is getting his money not over 3 years, now over 4 years, but he's still getting it. So
right.
there will be a compromise depending on who takes how much loss. So there has to be in today's time a loss allocation between a buyer and seller.
So you think they should negotiate somewhere midway so that it's a win-win for both?
It's across industries and across issues, because if you look at a rent arrangement between a landlord and a lessee, both are impacted because the lessee did not get the opportunity to use the premises. Lessor says, I'm still maintaining, I need my money. I think somewhere you need to come a midpoint or where you can share. Because in a situation like COVID, you can't say I'm right and somebody else is totally wrong. Correct? So I think there has to be a commercial answer to it. I don't think it lies in the court or tribunals.
Right. Vivek, there's also been a lot of talk about earnout structures becoming the structures post-COVID, because those are most likely to be more successful given their elasticity and the fact that they're dependent really on earnings and how the business is doing. Do you think that more acquirers will now start looking at earnouts as the way to go?
So I think, as I said in the beginning, the amount of risk that is now attached to transactions that are currently being done is higher than the risk that was attached to these transactions, let's say, pre-COVID. So how do I compensate for this is the key question. So one way of compensating could be, I actually penalize the value. I penalize the entry price. I was going to buy that asset for $100. Now I will buy it for $80 because my expected return on that investment would be higher because the risk is higher. So that is one way of handling it. In that sense, whether earn out, not earn out, doesn't matter. I have actually made an adjustment right at the top. So that is one way of handling that enhanced risk. The second thing we are seeing, and I would like to spend a couple of minutes on this. The second thing that we are now seeing is, especially for a lot of private equity buyers, when they get into either control or minority deals, they're saying, look, we will pay you the valuation that you wanted, that you wanted pre-COVID, or that we discussed pre-COVID, or we will pay you close to the valuation that you wanted pre-COVID, but we now want some sort of downside protection. This is not to say that you have to underwrite my capital. I'm still making an equity call. But what you must do is, if I get returns lower than a certain threshold, by reason of having paid you a higher valuation, you will adjust my valuation downwards. So let me explain how this will work. So let's say I'm doing a deal today at $100 and I'm buying 40% of the company as a private equity investor. I expect to exit that investment at $250 5 years out. That would be my, let's say, going in position. I want to make 2.5x in the next 5 years on $100 that I'm laying out today for picking up 40% stake in a company. I could tell the promoter, look, I will still pay you $100, which was my valuation for 40% pre-COVID. However, if I do not make 2.5 times, then you must true up partly. So we must bear or share risks partly. So let's say I will exit only at 200. If I exit only at 200, that means my original valuation should actually have been 80 for me to make 2.5 times. So now at that point in time, we will adjust. I would invest in convertibles today, and we would adjust such that my exit multiple is not 2, is not 2.5, but maybe somewhere in the middle, 2.25. So we are seeing a lot of risk hedged transactions, particularly in the financial sponsor community. And the example that I gave you of a ratchet was the simplest example. There are many more complicated mechanisms. There are many more objectives to achieve. I may want capital protection for a certain percentage of my investment. I may want the balanced investment to freely ride equity upsides. I may want caps and floors. So there are a lot of structures that are possible. All I'm trying to say is, in an uncertain, higher risk environment, I think these conversations have now become almost regular on every deal.
Just to add is, before the COVID, we used to have a lot of transactions where there should be upside sharing. That means if the return is higher than what the investor anticipated or expected, generally, like he said, 2.5x, and there used to be upside sharing with the seller. Now it's a reverse situation. And if you do not get the minimum, then there should be a sharing of the downside. Right, Vivek? That's what is happening.
Yes.
Right. So while we are talking about structures, we have a question, which is what would be the most attractive form of restructuring post the COVID pandemic? Would it be M&A, PE, or do you see other modes coming in as well? Vivek, would you like to take that up?
Sure. So look, I don't think there's one general most attractive form of what a company must or mustn't do in terms of its response. There will be companies who are fundamentally very strong in industry spaces which are not dramatically impacted by the pandemic and where demand comes back to normal. I think they will go back to normal life, and there they will raise money as and when they need, etc., etc. Some examples: companies like Levers, Nestle. These are all listed stocks. If you see their Jan, Feb, March quarter sales, they're probably higher than their Jan, Feb, March quarter sales of 2019, because all of us good Indians have stocked up on all the products that they make, right? Milk,
Right.
noodles, sauces, etc. Right? This is one category of companies. Two, there will be categories of companies which are impacted, which will therefore now start feeling the pinch because their leverage levels are higher than what their fundamental business could afford, and therefore they will have to see some form of restructuring happen. In an era where IBC has now been put on hold, I think under the June 7th circular, banks might look at some form of restructuring to happen. I also expect OTS windows to open and then one-time settlements be negotiated with bankers and so on and so forth. Refinancing of bank debt, and I've known a number of foreign distressed funds come into the market, scouting for such opportunities where they can refinance existing debts of fundamentally sound but deeply impacted Indian companies. I think one would see a lot of that happening. Third, of course, the point that the person who asked the question makes very, very correctly is, what about M&A? Will there be consolidation in sectors? So one is already beginning to see in certain sectors like the auto component sector, a lot of smaller, let's say 300 to 500 crore players are coming together and wanting to merge businesses such that they are stronger post-merger. Again, this is situational. So depending on where companies stand in their response to COVID and their impact from COVID, I think we'd see all forms of restructuring occur over the next 12 to 18 months.
Right. So let's move away from how we see deals happening in the future and what's happened to deals that were being negotiated before the pandemic hit. There's another bunch of deals which are actually now between signing and closing. And let's just work on the assumption here that there is no coverage of epidemics and pandemics under the MAC clause, which would give a buyer an out. Satish, what is your recommendation for those who are stuck in a transaction where a buyer or a seller is now trying to renege from his obligation to close the deal?
Well, this would depend on the facts of each case, but generally speaking, what would happen is, firstly, seeking specific performance in this country is very difficult. It is not a rule, it's an exception. So if somebody backs out of a deal, very difficult to get a specific performance. Number two, most of the documents gives a way out to a buyer. Maybe some condition precedent is not fulfilled. Certain things are there. Nobody would want to get into a debate or a dispute on what really the MAC means. MAC is very differently negotiated by different parties, but generally it says that if it impacts the business or it makes it difficult for the seller to perform its obligation or for the buyer to perform its obligation. So languages are quite wide enough, I think, to be able to get out of a transaction for a buyer. So my recommendation would be to the seller is try and get the deal done. In today's market, it's better to get it done because COVID is here to stay, looks like. It's not that when we say post-COVID, I don't know what it means. Is it 2021, 2022, maybe end of this year? So I think we have to learn to live in this period of COVID and assume this to be there for a reasonable amount of time and keep that in a background and do the transaction. So it's not the time to go to courts or arbitration to especially when it's a deal which is not closed. So it's better for the seller to get it closed because you won't get a buyer, right? Vivek, you won't get a buyer.
That's true. That's true.
Right, Satish.
And I mean, I would only add one sentence, and I don't know, this must be a very lawyer-focused audience, but give any document, even the clearest of document, to a good lawyer, and he will create some lack of clarity in it. So what Satish says is absolutely correct. Even if you have an absolutely clear binding document where the buyer must close, if you show it to a good lawyer like Satish, he will take out some point or the other which he can litigate. And then our courts at the best of times take a lot of time. But in today's time, commercial disputes are not the 150 matters that come up on video conference in 1 week in a court. So therefore, this will just drag in court for a long period of time and nothing really will work out. So at least my strong advice to clients is don't let lawyers sink their teeth into it beyond a point. Try and negotiate it commercially. Find a lawyer who has a commercial bent of mind and close it accordingly.
It's all about time value, right? If it goes on for another year, you don't have a deal. I think you've lost enough.
Yes.
Right, Satish. And on a related point for both of you, those deals which are still continuing, and I know there are a few and far between, but those would have the usual discussions around, you know, financial representations and business representations that would cover 30 pages of a document, against which sellers and businesses would have to make disclosures. Now, during these times, if you know you're going through this phase where your business was going normally, and now you've hit a roadblock where customers are walking away from their contracts, vendors are being unable to perform because they don't have workers anymore, so supply chains are getting affected. Financials are not looking the same because people are not paying on time, they're taking longer to pay. How do you deal with the concept of disclosures during such times? What do you do fundamentally if you're a seller and you have to make representations against disclosures against such representations?
I think presently, pre-COVID, we had, and also the court interprets disclosure very strictly. They have to be specific. But going forward, I don't think we will be able to make only specific disclosures. We'll have to have little more generic language, because especially for contracts, employee related, as far as tax is concerned, yes, you may be able to, but there are a lot of heads under which you will have to have general disclosures or disclaimers for situations like COVID. But I think all this we will know in soon, because once we start negotiating contracts, we will all know where we land up and
Right.
and you know how much bargaining power you have as a seller or as a buyer, depending on which sector again. So the willing buyer and a willing seller, we'll have to see how it pans out. But definitely a lot of negotiations will be there, because also for another reason is that now it will be very, very difficult to get indemnity insurance.
Mm-hmm.
Earlier we could get on title, we could get on tax, we could get it on business reps. Easiest was on title, more difficult was tax, then much more difficult was the business reps. Going forward, I don't know how many insurance companies would want to give insurance for indemnity for business reps, because certainty is very low. Because we've done diligences for insurance companies who want to give, as it is in normal circumstances, they dig very deep. But given the COVID situation, they will have, in fact, for example, we would never check in a supplier contract whether the force majeure clause was there, how good the force majeure clause was there. Today, everybody will read that if it is important to the company. I'm quite sure none of us, really paid as much attention. So things have changed. We will look at things differently. Everybody will start focusing at what will be the risk if a situation like COVID comes up again.
Okay. And
I think I will just like to, sorry to interrupt. I will just like to add one more thing.
Sure.
See, the concept of truing up the disclosure to closing. So normally one would give a disclosure letter at the time of signing,
Right.
and that would be the disclosure letter that will hold pretty much. I think the concept of truing up the disclosure letter to the point of actual closing, let's say sign and close has a CCI approval or other approvals, and there's a 3 to 6 month interregnum. I think that will become now a very cardinal principle, which will be insisted by both seller and buyer. And that actually also creates the uncertainty for people to navigate away from a deal, because a buyer can always say that a new disclosure made during that interim period is something that's not acceptable and therefore I'll walk away. So I think one large part of what transaction lawyers will have to now negotiate is, how do I keep the deal intact between sign and close? And what are really the uncertainties, the CPs, updation of disclosure letters, force majeure events, max, etc. So I think these parts will now start getting negotiated with the same passion and excitement as ROFRs and board representations and governance rights and exit rights used to get negotiated in the past.
See, nowadays, now what will happen more is also that you will try to keep, of course, subject to regulatory, people will try and find structure with the least regulatory involvement, so that the gap between signing and closing is less. Or they would not sign till they have reasonable certainty that the condition precedents would have been fulfilled. So we don't know how it will pan out, because from a seller's point, or even sometimes buyer's point, you want certainty. And like Vivek said, certainty is getting reduced because of the situation.
Understand. And don't two of you think that purchasers will be more willing to accept general disclosures to specific representations because of the pandemic? Do you think that mindset is going to change? Because usually purchasers will always insist that they may be made specific. But if you go into the 3 months of the pandemic, I think there could be a deluge of disclosures to which there could be absolutely no end.
I think what will happen is there'll be a lot of negotiation. We used to use the word material breach. Okay, so a lot of reps and warranties are caveated by material. But I think now material will have to be defined in terms of financial impact and impact on being able to carry on the business in the ordinary course. There will be a lot of discussion on that. Hello?
I think Pritha probably has a connection problem.
We got to add this.
Satish. No, so Satish, do you want to pick up a question that's in the chat? And I can read out that question to you. It's exactly on the point that Pritha asked you, which is, Satish, can you elaborate on the indemnity point? Any specific change? This is a question from Ravi.
Yeah.
Do you want to pick that up? If you see the chat box, you'll be able to see the question.
Okay. No, on the indemnity, there's no specific change, but the change will be now clear that as far as indemnity claims are concerned, they will be there, but getting insurance for indemnity would become difficult. So that would be a problem. So today, a lot of the sellers rely, especially private equities, on going and buying an insurance. That would become very difficult to obtain an insurance policy for an indemnity claim.
Okay, so I think while Pritha still joins, we can also clear the other questions in the chat. There's a question which says, shouldn't normalized EBITDA work time extension may not be feasible, isn't it? Else renegotiate the earnout deal and subsequent tranches. So the point that I was making was, normalized EBITDA, if it's not a concept in the agreement, it is something that will have to be answered commercially, or that is something that will have to be asked commercially and negotiated between both parties. What I would expect is, instead of buyers being willing to pay on normalized EBITDA, they will do some sort of averaging across a longer time frame and pay on actual performance still. And of course, this depends from situation to situation. But usually, I don't think buyers will want to pay earnout amounts on notional EBITDAs. Okay, Pita, you're back. So we'll hand it
Yes,
back
I'm
to you.
sorry. I'm sorry for that. Sorry for that interruption. So moving on to the next question, Satish, there are a lot of regulatory developments that have happened owing to COVID. There are changes to the FDI regime, there are changes to local laws. And I will pick Vivek's brains on overseas investments now being permitted a little later. But how do you think this will have an overall impact to the amount of time that regulators would generally take to grant approvals for transactions?
The main change in the FDI has been the press note 3, which is basically prohibiting, if the investor, ultimately the beneficiary is a Chinese entity, then you need a government approval. Now, government approvals in the COVID situation, I do not know how long it will take. I don't think as of now anybody would have approached any regulator for an approval, and that approval would have been granted in a time like today. So going forward, I think we'll have to find structures where we have to avoid regulatory requirements. For example, deals will be more share buyout. Instead of, we were looking at slum sales, demergers, and then buying into the demerged entity or in the merged entity. All those structures will take far longer, at least in the next 1 year. So
Right.
I think the structures will be more workable, would be the straightforward, buy shares of a company, you take over that company. Because there's no regulatory approval, lesser level. However, there could be still regulatory approvals required because of certain sectors, like RDA, you need SEBI approval. If it's an NBFC, you need RBI approval. Those will obviously take far much longer.
And are you
More
seeing
KYC, there could be far more KYC by the regulator. As it is, regulators are taking longer in the last 6 months to 1 year. What we've been seeing at whether at the RDA or RBI, it's taking much longer. So
right, Satish?
far more now.
Right. And do you think the developments that are having that we're having on a daily basis on just local laws, for example, states are passing ordinances and legislations, pulling out labor laws or making strikes illegal. Do you think that's also going to create some impact on the psyche of buyers and investors?
Definitely that would, because of the, again, uncertainty. What if a strike is called? What if wages have to be paid despite the fact company doesn't have money to pay? All this will always scare the buyer. Or we'll need to make sufficient provision for that situation to arise. But again, what is uncertain, what will be the period for which you need to continue to comply with a law which has a financial impact? Is it 1 month, 2 months, 3 months? So again, coming back to what Vivek has been saying, preparing a business plan or a future business or expectation from a business is going to be very difficult, because all these advisories, notification, press notes which have been coming out are creating a lot of uncertainties, and which could have significant financial implications. So
Vivek, what do you think about?
So 2 points. Let me come in here before you ask me the question on what Satish said. So 2 points on the China circular. So number one, I think direct investments from China by Chinese companies. So if Alibaba wants to double down, Fosun wants to double down on any of its existing investments, I think there is no doubt Xiaomi wants to put in more money. I don't think there's any doubt that therefore they will be able to put in more money only through government approval. And at least what we hear from the government, and we've been in very close touch with the government on this, is that DPIIT will put up an online portal, and subject to security concerns, etc. They will look at a very time-bound 3 to 4 week process in which to accord this approval. There is, as Satish very correctly pointed out, there is no live case which has got what I call the China approval yet. So the proof of the pudding will be in the eating. But at this point in time, I think the government is at pains to explain to everyone that this will not unnecessarily hold up the investing activity that should occur in India from a Chinese perspective. The second point on the China circular that I'd like to make is, while it's very clear that China-owned companies will indeed be covered, where do private equities stand? So let's take the case of any large blue-blooded private equity. It has investors from across the world. So maybe 20%, 30% of its capital is from North America, 30% of its capital is from Europe, and 30% of its capital is from Asia. In the Asian capital, it's possible 5, 10, 15% of the capital is from China. Now, I think the government has still not clarified. So while the central government notification as well as the RBI notification is before us, the government has still not clarified what they mean by beneficial ownership and what is the level of stake which they will consider as being Chinese stake in the context of beneficial ownership. Now, this I think will have an impact particularly on private equity transactions. A lot of large private equities invest out of Asia vehicles where the Chinese ownership may be higher. Now, these investors are actually not controlled from China at all. But because they have LPs who have contributed into a private equity fund structure, I just hope that this China circular doesn't hit that kind of investment, because that will then have a ripple effect on investment across the economy. So these were the 2 points I wanted to make on the Chinese circular. But happy to now answer. Sorry to have interrupted, and happy to now answer the question you were going to ask.
No, not at all.
Sorry, there is no clarification yet for the government to what extent. That's why the KYC becomes critical. When will they stop? Because if you have to provide all the details of the ultimate beneficiary, it would become impossible, especially in cases of private equity funds. Because you could have funds of funds of funds. So it's just impossible.
Right. So on that related subject, we have a question, which is, what if the fund manager is Indian? Isn't it considered an Indian investment then?
No, it is considered as domestic fund because the sponsor is here, the manager is domestic. So you could be treated as a domestic fund, but still the beneficiaries could be and can be a Chinese entity.
I think a lot of people also, Satish, were expecting that, once the press note came out, that there would be certain clarifications when the FEMA notification came out. But unlike what everybody else expected, that just happened to be a replica of press note 3, and there was nothing more. Do you think it's still work in progress, and that the government will come up with new clarifications for China investment? Because immediately after press note 3 happened, there were a lot of news reports that now they're trying to create a speedway for Chinese investments, because obviously there was a lot of talk of what happens now. So do you expect anything more?
Definitely, they will have to clarify. Otherwise, people would be scared to invest. Even funds, for example, want to invest. They don't know whether one of the LPs or one of the funds of funds, the ultimate beneficiary, and how will, if later on it surfaces, how will the government look at it? Because there's no clarity at all. So definitely investors will start thinking twice whether, or if they want to take a conservative view, they say may as well go to government and seek an approval. And that will definitely delay the investment.
Right.
And to this question, which says, what if the fund manager is Indian? Isn't it considered Indian investment? So it is considered Indian investment only if the fund manager is Indian and the investment is from an AIF vehicle. If the investment is through a regular fund, even if the fund manager is Indian, it is not considered an Indian investment. Only for a SEBI registered AIF where the fund manager is Indian or the manager entity is Indian owned and controlled. That's how it's actually technically defined. Is it considered India investment and therefore not subject to press note 3? If I have a manager entity sitting in India but advising a Mauritius fund, which is the structure for, I would say, 90% of our funds which exist in India, then it is not considered Indian investment. It's subject to all FTI restrictions and therefore impliedly to press note 3 also. This was the first question that I wanted to answer on the question Q&A box. The second question is, if it is considered Indian, so no clarification required. Yes, for in the limited case where you have an Indian manager of a SEBI registered AIF, no clarification is required. But for the balance 90% of cases where you have the classical fund structure, clarification on extent of beneficial ownership and how many levels up will one go is still required. The two definitions that are doing the rounds are either the 10% threshold under the Companies Act, which is the significant beneficial ownership threshold, or then the PMLA KYC thresholds, which are 15 and 25% respectively. But at this point in time, there is no clarification from the government on that.
Right, Vivek. And Vivek, what do you think about the timing of the announcement of the government that Indian companies can now be listed overseas before listing in India? This is something that they have tried to do in the past as well, haven't they?
Yes, so direct overseas listing of Indian companies. So right now the law is, if you want to list on an overseas stock exchange, let's say if I want to go to NASDAQ, I must be listed on an Indian stock exchange earlier. So Infosys, Wipro, all are listed on the NASDAQ through ADRs or a US exchange through ADRs, but they're also listed in India. That's the law right now. What the government has been grappling with, and I think this is a conversation that's been on for 10 years, finally confirmed this Sunday by the finance minister, the last Sunday by the finance minister, is that they will allow direct overseas listing of Indian companies. I think for a large number of private equity and venture capital portfolio companies, this is huge because you don't have to list yourself in Bombay or on the National Stock Exchange. You can directly go and list overseas where the markets are deeper and arguably you will get better valuations and better recognition. So this is what the government intends to do. I think this needs changes from a SEBI and RBI regulation perspective. This has some tax issues also. I would expect to see in the next 15 to 30 days a detailed set of guidelines as to how this can work. Pritha, to your observation that this has been there in the past as well, you're right. In 2013, this window was open for 2 years, but then it was closed because it was felt that a lot of, let's say, non-institutional money found its way back into India through the foreign listing route. And therefore now I would expect the regulations to restrict themselves to just a few stock exchanges across the world, which are the most recognized. I think they will talk about diversity of investors, diversity of holdings, and they will talk about disclosures, etc. I think this is a very exciting opportunity for Indian companies who want to take the benefit of an overseas listing directly. They don't have to follow crazy externalization structures or do exotic stuff like that, but the government may allow them to directly list overseas. I'm watching this space very, very closely. And I'm actually very optimistic on what can happen with direct overseas listing.
Just to add what Vivek just said, I think another important factor which will be considered by the regulators is the strong money laundering laws in the relevant jurisdiction. Because this was one of the worries of the government, that whether this will allow money laundering.
Right.
So I think limited to a few jurisdictions.
Right. So, and while we're all on that subject, recently Mauritius has also been included in the grey list for the FATF. What does this mean, and how much of an impact do you think this will have for funds, Vivek, going forward?
So look, so Mauritius was just a routing vehicle for used when it was a very efficient vehicle from a capital gains tax perspective. Now there is really no treaty benefit in terms of coming through Mauritius. It isn't as if it was Mauritius money that was coming in.
Right.
Which is perhaps now why it's a grey jurisdiction under the FATF as well. Now, in terms of impact, I think existing funds set up in Mauritius in a private equity format will not be impacted, because these are funds that are already set up. They're either registered with SEBI or are FDI investors, and they would be able to invest in regular form. I think where this will have a direct impact is when FPI applications from Mauritius are renewed periodically, or when new FPI registrations are sought. The government is looking at them very, very carefully, and reports are that the RBI and SEBI are basically deferring all applications that are emanating from Mauritius. Representations, I understand, have been made from the private equity and the investing world to distinguish these kind of institutional vehicles versus other investors. Let's see what happens. I think those are the sectors that are impacted. So, for example, if I have to invest in an NBFC, I must take RBI approval. If I'm investing through Mauritius, that RBI approval is perhaps now not so easy.
Right.
But existing private equity structures, I don't think will face dramatic impact. It's only new FPIs or FPI renewals, which I think will see impact.
Right. We're almost up on the hour, gentlemen. So if I can just get closing thoughts from both of you before we stop for the day. Vivek, would you like to go first?
Sure. So look, I would say tough times, more than tough times, uncertain times, which bring forth a lot of interesting legal questions. So for this community which is on the call, I think I would even say good times, because there will be a lot of questions that will get asked to you, and one has to navigate this carefully. From a deal standpoint, I would say time to be open to different structures, time to be open to renegotiations and reconversations. But I'm hopeful that 6 months later we'll be out of this.
Right. Sorry, Vivek, just one question came in as you were speaking. What's your view on whether Hong Kong investments are included within the China circular or not?
So Hong Kong is a part of China. Hong Kong investments are treated exactly like any investment from Beijing or Shanghai.
Right. Satish, your closing thoughts?
I think we should be, as lawyers, open to new clauses, new provisions. Cannot say, I've done this 50 times earlier. And I think new precedents will be set.
Don't copy and paste.
Right.
So we have to be innovative. We have to think out of the box. We have to create new precedents.
Right. Interesting times ahead, I think, both in the structuring world of finance as well as on the legal front in negotiating new transactions. It's going to be a whole new world out there. Thank you, gentlemen, for sparing your time with us this evening, and thank you to the audience for participating and for all of your questions. Have a good evening and a great weekend again. Thank you.
Thank you. Thank you very much.
Stay safe.